Welcome to Speidel's California Minute. I'm your host, Catherine Zidane. This week, we're covering the tax changes in the governor's proposed budget revision. We provide complete analysis of all tax legislation at Speidel's federal and California year-end tax update. See which topics we'll be covering this year and get registered for a live seminar or webinar session at caltax.com. Governor Newsom released his 2025-2026 May budget revision on May 14th, which contains several significant tax proposals. The revised budget proposal provides for a military retirement pay exclusion of up to $20,000 of military retirement income for taxpayers with up to $125,000 in income or $250,000 for married filing jointly. California is the only state that does not fully or partially exempt military retirement income from state taxation. The budget proposal provides for an exemption for all wildfire settlements paid in tax years 2025 through 2029, regardless of when the fire occurred. Last year, the governor vetoed both AB 1973 and SB 542, which would have excluded from gross income settlement amounts received for the 2020 Bobcat Fire and the 2021 Dixie and 2022 Mill fires, respectively. In his veto messages, the governor requested that exclusions for these fires be considered with the 2025 budget. However, the budget proposal doesn't address those fires. We'll have to wait for the final budget to see if settlements for those fires will qualify for an exclusion. However, AB 429 was introduced in the current legislative session, and this bill, if passed, would exclude any amount received in 2022 through 2026 for wildfire-related settlements from the Dixie and Mill fires. The budget proposal provides an extension of the pass-through entity elective tax, but only if the federal SALT cap is extended. The current version of the House tax bill would increase the SALT deduction limit from $10,000 to a maximum of $40,000 or $20,000 for married filing separate. But other provisions effectively repeal IRS Notice 2020-75, which is the guidance that allowed partnerships and S corporations to claim a federal tax deduction for pass-through entity elective taxes. Given that the tax bill would prohibit pass-through entities from claiming a federal deduction for pass-through entity taxes, it's unclear how beneficial the budget's extension provision would be. And the proposed budget also contains the following provisions: an increase in the amount of the available California film and television tax credit awards that can be allocated annually from $330 million to $750 million for fiscal years 2025-2026 through 2029-2030, and the requirement for financial institutions to apportion their business income to California using the single sales factor rather than a three-factor formula comprised of payroll, property, and sales factors. Absent from the governor's proposal is the repeal of the NOL suspension and the business credit limitation for the 2025 tax year. The NOL suspension and business credit limitation currently apply to the 2024 through 2026 tax years. As part of the budget deal reached last year, SB 175 allowed for the elimination of the NOL suspension and the business credit limitation if the California Department of Finance determined there was sufficient revenues in the general fund and the Annual Budget Act provides for the elimination of these provisions. The governor's proposed May budget revision is often seen as the kickoff point for negotiations with the legislature, which has to pass a budget by June 15, 2025. We'll provide updates on these proposed tax changes as well as any initiated in the legislature as the legislative session unfolds. You can stay up to date with these changes with a subscription to Speidel's California Tax Letter. For details, go to caltax.com and click Publications. That's all for this week. Join us next time for another episode of Speidel's California Minute.